The story of the $50 trillion shadow banking system does not begin in a boardroom, nor in a government office, nor even on a trading floor. It begins in the silence between the numbers, those vast invisible spaces where capital moves without a trace, without a name, and without a single human being ever realizing what flows beneath their feet. In the official world, we are taught that banks shape economies, that central banks maintain stability, and that governments oversee everything that touches money. But this belief is a comfortable illusion, because behind the visible architecture of global finance lies a second, far more powerful structure, one that operates in darkness, beneath the radar of every regulation humanity has designed. To understand the weight of this system, imagine walking through a massive financial city at night. The skyscrapers glow with the confidence of regulated institutions, commercial banks, central banks, investment companies, agencies, and financial ministries. But beneath this clean skyline, under the polished steel and glass, lies another network. Silent corridors extending deep into the underground, lit only by red flickers of fragmented data and ghost-like streams of liquidity. These pathways connect hedge funds, private lenders, money market funds, repo dealers, offshore vehicles, and securitization networks. Entities that are not technically banks, but behave exactly like them, without the rules or restraints of traditional banking. This is the shadow banking system, a term so misunderstood that most people assume it refers to something illegal. In reality, it is simply unregulated banking. It is a massive parallel ecosystem of credit creation, where loans are issued, assets are traded, risks are packaged, and liquidity is generated outside the reach of central banks. And unlike the traditional system, this one does not require reserves, safeguards, or transparency. But markets do not always function, and this system is built on that fragile hope. As the global economy expanded through the late 20th century, regulated banks found themselves constrained by strict rules, caps on lending, capital requirements, liquidity buffers, and risk limitations. These rules were meant to protect the public from the dangers of excessive speculation, but Wall Street, London, Hong Kong, and Singapore found an alternative path. If the regulated system was too restrictive, then the unregulated one would take the lead. So began a quiet migration of risk. Loans that banks once held were moved into securitized products. Credit that banks once extended was now offered by hedge funds. Funding operations banks once controlled shifted into repo markets. The consequences were profound. For the first time in modern history, the majority of global credit expansion occurred outside the banking system. But because this ecosystem was invisible to the public, its growth went unchecked. No one realized when it crossed $10 trillion. No one noticed when it doubled again. And by the time economists finally recognized its scale, it had passed the $50 trillion threshold, larger than the GDP of dozens of major nations combined. Yet what makes the shadow system truly dangerous is not its size, but its invisibility. Traditional banks report their assets, their risks, their liquidity, and their failures. Shadow institutions do not. They are wired together with fragile contracts, overnight lending chains, synthetic derivatives, and opaque credit vehicles that not even their own analysts fully understand. And because they are not required to hold the same safety buffers as banks, their stability depends entirely on uninterrupted market confidence. The moment confidence breaks, the system collapses like a structure made of glass. And still, millions of people have never heard of it. In the opening of our story, we stand in the dim glow of this unseen machine. Its gears are spinning, its pipelines are full, and its operators assure the world that everything is fine. But history has shown that systems built on speed and opacity do not remain stable forever. Economies depend on trust, and trust is a fragile currency. When the shadow system trembles, entire nations feel the shock. When its liquidity evaporates, markets freeze. When its chains break, banks fall, businesses collapse, and households pay the ultimate price. And yet governments cannot regulate what they cannot see. Tonight we begin a journey into the deepest layers of global finance. Not the world you see in textbooks, but the world that actually moves the global economy. The world that lives in silence, thrives on complexity, and hides behind the comforting illusion of stability. This is the story of the $50 trillion shadow banking system, the world's largest financial structure that nobody controls. And in the end, you will understand how this invisible system became the most powerful force shaping your future. To understand how the shadow banking system grew into the invisible engine of the global economy, we have to travel back to the 1980s, an era of chaos, creativity, and financial rebellion. Traditional banks were trapped in a cage of hard rules: reserve requirements, lending restrictions, leverage limits, and government oversight. These rules annoyed Wall Street because they slowed down the one thing financiers valued most: speed. In markets, speed is power, and any obstacle standing between a trader and profit becomes an enemy. So instead of fighting the regulations directly, Wall Street found a hole in the system. If a financial activity is done by a non-bank, then the rule doesn't apply. And with that one loophole, a revolution began. Hedge funds, private equity firms, investment vehicles, and offshore entities started offering bank-like services: credit, loans, liquidity, and leverage. These firms were not banks on paper, yet they behaved exactly like them, sometimes with even more influence. They created their own money supply in the shadows, not in physical bills, but in the form of short-term funding, synthetic credit, repo contracts, and securitized debt. This shadow money system became the lifeblood of modern capitalism. One of the earliest and most explosive innovations was securitization. Instead of holding loans on their balance sheets, banks began packaging them, mortgages, auto loans, corporate debt, into complex financial products that could be sold to investors. This allowed traditional banks to lend endlessly without appearing to increase risk. But the deeper trick was this: most of these securitization pools were not held inside banks. They were moved to off-balance sheet vehicles, special entities that nobody regulated. These vehicles issued their own forms of money, short-term notes backed by long-term loans. The system looked safe on the surface, but underneath, it created a time bomb. Because whenever markets panicked, these shadow vehicles would run out of funding instantly, long before regulators could intervene. By the late 1990s, deregulation opened the floodgates even further. The repeal of protective laws blurred the lines between banks, brokers, insurers, and investment houses. Everyone wanted a piece of the shadow system. The rise of the repo market, a borrowing mechanism that allowed institutions to trade short-term cash for long-term securities, turned Wall Street into a high-speed liquidity machine. But like a machine running on nitroglycerin, a tiny spark could blow it apart. Repos were based entirely on trust. If one player doubted the collateral, the whole chain froze. This fragility remained invisible until one day it wasn't. That day came in 2007-2008, when the shadow system finally cracked. Mortgage securities were imploding, confidence was collapsing, and the funding markets that had powered the world's largest financial institutions evaporated overnight. Banks were blamed for the crisis, but banks were only the face of the problem. The true collapse happened in the shadows, in the securitization structures, the money market funds, the repo chains, the derivatives networks, and the off-balance sheet entities that had grown far beyond the reach of government control. When Lehman Brothers fell, it wasn't just a bank collapsing. It was a critical node in a global shadow network disintegrating. And when the network failed, the world discovered the truth. The modern economy had become dependent on institutions that were never designed to be safe. You might assume that after the 2008 collapse, the world learned its lesson, that governments cracked down, imposed regulations, and tamed the shadows. But the opposite happened. Instead of shrinking, the shadow system adapted. It evolved. It multiplied. New forms of private credit emerged, offering massive loans outside of banks. Hedge funds moved deeper into lending markets, providing financing to companies that no bank would touch. Private equity firms started borrowing billions through unregulated channels. Even traditional money market funds transformed into high-risk liquidity engines, offering near-banking services without the protections banks must maintain. Why did this happen? Because after 2008, banks were forced to strengthen their balance sheets, hold more capital, and reduce risky activities. This created a vacuum, an opportunity, and the shadow system rushed in to fill it. Today, pension funds, insurers, sovereign wealth funds, And corporations all rely on shadow institutions for returns. The world has become addicted to yield, and the shadows offer what the regulated world cannot: high returns, fast money, and low visibility. But the danger has also multiplied, because unlike banks, shadow entities do not have deposit insurance. They do not have central bank support. They do not have emergency backstops. When a crisis hits, they cannot call the Federal Reserve for help. They simply collapse. And when they collapse, they drag the system down with them. The scariest truth is this: shadow banks are now so deeply connected to real banks that a failure in one instantly hits the other. Banks rely on repos. Repos rely on hedge funds. Hedge funds rely on derivatives. Derivatives depend on collateral flows. Collateral depends on market stability. And market stability depends on confidence, an invisible string that can snap in a single moment of panic. This interconnectedness means the system is more fragile today than ever before. A large private credit fund defaulting, a repo chain breaking, a sudden liquidity freeze. Any one of these could ignite the next global financial crisis. And because the shadow system is unregulated, the collapse will be fast, far faster than 2008. We are now living in a world where the most powerful part of the financial system is the part nobody controls. A system built in secrecy, a system expanding without oversight, a system so large that even central banks admit they cannot map it entirely. This is the evolution of shadow banking, a journey from loopholes to dominance, from innovation to danger, from obscurity to a $50 trillion empire shaping every market on Earth. The $50 trillion shadow banking system stands today like a giant made of glass, towering, powerful, and awe-inspiring, yet fragile in ways the world refuses to acknowledge. It is not a single institution, nor a single entity. It is a web, a nervous system of global finance that stretches across continents, connecting hedge funds to pension funds, private credit markets to multinational corporations, money funds to repo dealers, and governments to invisible lenders they can neither regulate nor fully understand. And as the scale of this hidden empire has increased, so has the potential impact of its collapse. To understand the danger, imagine a vast labyrinth beneath the global economy. Every step above seems stable: jobs, businesses, property markets, investments, government spending. But beneath that surface lie thousands of interconnected chambers, liquidity pools, derivative chains, risk engines, leveraged credit lines, and synthetic debt instruments. All of these chambers are connected through narrow corridors that must remain open for the system to function. If one corridor collapses, pressure builds. If several collapse, the entire labyrinth begins to shake. And if a major chamber breaks, the surface world, the real economy, starts to crumble. This is why economists fear the shadow system, not because it is inherently evil, but because it is inherently unstable. Shadow institutions rely on short-term borrowing to fund long-term assets, a structure so fragile that a moment of panic can turn liquidity into dust. A private credit fund lending billions to corporations might seem strong today, but if its investors demand their money back, it cannot call the Federal Reserve for help. If a major hedge fund loses confidence in its repo lenders, overnight funding evaporates. If collateral values fall suddenly, derivative contracts unwind at hyperspeed. When one chain breaks, the shock spreads instantly across markets, faster than any regulator or central bank can respond. This fragility is not hypothetical. It nearly happened again in March 2020, when the COVID-19 panic froze the global repo market within hours. As liquidity vanished, even the safest assets, U.S. Treasury bonds, began to lose buyers. Money market funds broke, credit markets choked, and the entire global system was moments away from a catastrophic seizure. The crisis was only stopped because the Federal Reserve intervened with trillions of dollars in emergency support. But here is the uncomfortable truth. The only reason the system survived was because central banks bailed out the shadows. Again. This raises a terrifying question. If the shadow system is too large to fail, but also too unregulated to control, what happens when the next crisis is bigger than even central banks can rescue? Consider private credit markets, which have grown from a niche industry into a multi-trillion-dollar powerhouse. These funds lend to businesses that cannot get loans from banks. They promise investors high returns, but they operate without deposit insurance, without strict capital rules, and often without transparency. If a major private credit platform collapses, thousands of companies could lose funding overnight, triggering layoffs, failures, and economic shockwaves. And because private credit is interconnected with banks through hidden channels, the damage would spread instantly. Or consider the global derivatives market, where trillions in synthetic exposures are traded daily. These contracts rely on stable collateral, but collateral values change, markets fluctuate, and panic can cause immediate margin calls. One large default could force hedge funds to liquidate assets rapidly, destabilizing stock markets, bond markets, and even currency markets in hours. The scariest scenario is a full-scale liquidity freeze. In such a moment, shadow lenders would stop lending, repo dealers would refuse collateral, money funds would shut withdrawals, and corporations would be starved of cash. Economic activity would slow instantly. Payrolls missed, shipments halted, credit cards declined, ATMs running out of cash. This is the nightmare economists call a financial sudden stop, and the shadow system increases the likelihood of such an event dramatically. But beyond the technical dangers lies a deeper problem: accountability. Nobody elected the shadow system, nobody oversees it, nobody controls it. Yet it controls the financial destiny of billions of people. When it booms, markets rise and economies grow. When it panics, the world suffers. It is a silent, invisible governor of global capitalism, a governor with no face, no responsibility, and no obligation to protect the public. Still, the future is not hopeless. There are three paths the world can take. Path 1, reform. Governments could integrate shadow institutions into regulatory frameworks, requiring more transparency, stronger liquidity buffers, and clearer risk reporting. This would not eliminate the system, but it would make it safer. Path 2, ignore. The world can continue pretending everything is fine, allowing the system to grow unchecked until another crisis forces intervention. This is the path we are on now, comfortable, profitable, and extremely dangerous. Path 3, collapse. A major shock could break the chain before governments act, and if that happens, the consequences will be global. Bank failures, corporate bankruptcies, sovereign debt crises, market crashes, and economic paralysis. But there is also a fourth path: awareness, because the first step in controlling a hidden system is exposing it, understanding how it works, recognizing the risks, seeing what was once invisible. And that is where this documentary leaves you, not with fear, but with clarity. The shadow banking system is powerful because it hides in darkness. But once brought into the light, it becomes something else entirely, a challenge the world can confront, regulate, and eventually reform. In the end, the biggest danger is not the $50 trillion sitting in the shadows. The biggest danger is pretending the shadows don't exist. This is the final message. Until the world acknowledges the invisible forces shaping global finance, the next crisis is not a possibility. It is a guarantee. But awareness gives us a fighting chance, and that chance begins here.